All right, so we should be set there. Gonna share this with the group. Huh, okay. All right. Get started in just a minute here. So, this is sort of a impromptu stream. I wasn't planning on doing this. So I've decided to do it into two different parts because I have a tool that I've been working on for a while here that I think will really help you guys with risk management. I've released this tool before, and it wasn't as focused on calculating risk as I wanted it to be. So I am gonna do a part 2 to this on Friday for a morning live stream. In the meantime, today we're not going to get so much into the calculation of it. I want to talk more today about entries, take profits, and just generally trading setups. I think that what I've been seeing a lot in the Discord lately is a lot of knife catching. Okay, so I've been seeing a lot of like people trying to catch these big pumps, or as price is climbing, I'm hearing, oh, is it time to short? Is it time to short now? So I'm gonna talk about that. I'm gonna talk about limit orders, and when it's appropriate to use them, and you know, um, just like I said, general trade setups. And then on Friday, I'm gonna sort of recap what I talked about today, and then we're going to get into like the specific calculations of risk management and like like your position sizing per trade. And I'm gonna make a basically a calculator in an Excel spreadsheet that all you have to do is input the numbers and it'll do the calculations for you and tell you exactly what your position size should be. So I'm gonna start with Bitcoin and channel trading. I've made a tutorial video about this in the past. You can find it in my beginners tutorial channel, but I'm going to recap a little bit of how channel trading works. So channel trading, so when price came to here, right? This was a Saturday morning. I put this channel in, and it was based on this low here and this high here. Okay. And how channel trading works is you long the bottom and you short the top of the channel over and over again. You have a take profit set at the midline and at the opposite side of the trade. What you can do is you don't have to close the trade entirely here. You can leave part of it open in case, we break down, then you have a runner, right? Same can be said for a break to the upside. You don't close it fully here. You leave a runner. I usually like to close 50% of the position here, 25% of the position here, and leave 25% as a runner. And keep my stop loss as it was, and ultimately I end up hedging throughout the trading of this range. You end up being hedged for either breakout, right? And of course, typically when you're channel trading, you have a bias towards what side you think that something's going to break out on. So in channel trading is not the time that you want to use limit orders, and here's the reason why. When you're channel trading, so I'll explain to you how this works, right? You're going to use market orders, and here's how it would work. So we get down here, right? We see this deviation, we reclaim. Okay, we enter along, we take profit here. Let's zoom in on this one a little bit more. So we enter along here on reclaiming the channel, take profit here. Our stop loss is below here. Okay. Price comes down again. We long again. We keep our stop loss here. So we closed 50%. We're going to open that back up here. We take profit again. And, you know, you could have done it here if you were feeling that it was close enough. I don't know that I would have personally, but you could have here again. So here we are. We're holding this here. We have no reason to close. Again, price comes back down here, right? We add more of our long again, and we keep our stop loss here. And we wait, and we wait. Stop loss not taken. We get the move up. We take profit at the midline. We take profit at the top. We leave 25% as a runner. Let's say we get up here and we say, oh, I think this is plenty for my, we actually did have some confluence in this zone. We had some resistance, a naked point of control. So you could have said, all right, I'm going to take more profit here. I'm actually going to close that. So you made profit here at the midline, at the top, and you hit a third take profit here at a naked point of control. Price comes back down. Massive rejection. A massive, massive rejection. So what do? You open up a short here on the back test after this massive rejection. You short, you take profit at the midline, and you would have your stop loss. This might be a little high. You know, basically you're supposed to put it at the high and the low of the range. You know, I would have done something a little bit less than that, you know, maybe up here. Here, take profit here, right? Now we flip to long again. So we long here. Where do we put our stop loss? At the low of the range here, right? We come up, we short again here. Again, our stop loss is here. So we short again, take profit at the midline. Again here, right? And this, so this is a great example here. So here, we would have been stopped out, right? So we would have taken the short here and it would come down, but it would not reach our take profit. So we would have been stopped out here, right? Now we have a naked point of control here when we saw a rejection off of it. And here we could have entered another position. And I'm just curious. Where is that move? Here it is. Yeah, so and here's the thing with this channel trading, right? Is what often happen is people get so eager, you know, on the way up here. They're like, "Oh, should I short here?" And then they get wrecked here. You know, all right, should I short here? And then they get wrecked here. You know, should I short here? And by then you've tried shorting 4 times. Here's the thing is that you don't want to short. Here's the deal. If I go to a 30-minute time frame, is this a better short or is this a better short? The answer is that this one is. Now, chances are if you shorted this top, you didn't catch the actual top. Chances are you probably caught somewhere in here. Right? So price comes down and you don't take profit and you're thinking, great, perfect. And then price revisits your entry here. When price revisits your entry, you're more liable to make a mistake, to close your trade, to think, oh man, I really messed up, right? And then it comes back down again. And then it comes back up again. Now look at this. This is a 2 o'clock to 10 o'clock. So this is an 8-hour time frame up here. So because you entered here, or you attempted to enter here, you're holding your trade for then 8 hours up here. You know, instead, oh, and by the way, when you enter here, you don't really have a place for your stop loss as you're trying to catch the top. Now, if you had entered here and put your stop loss either here or here, knowing that we've been, you know, that we're seeing weakness, we have a change in market structure, all of a sudden your all of a sudden, and let's say you're going to target all the way back down to the bottom of the range. Now you have a place for your stop loss, right? You can even put it up here. Now you have a place for your stop loss. Now you have a selected entry. This is a trade, okay? When you have somewhere to enter here and you have a spot for your stop loss versus just trying to knife catch and hope. Hope is not a trading strategy. You enter here and you hope that it's going to go down. Okay, just like you would enter here and you hoped it would go down, or you entered here and you hoped it would go down, or here, and finally here, right? The point is that oftentimes people are in such a hurry to get into a trade. The best thing that you can do is just let it play out, because oftentimes, like here, you had 8 hours to get an entry. And the longer you waited, to some degree, the better the entry was here. So you could have some degree of a stop loss, and then you have your targets, your take profit one here, here, and here, right? So the thing with channel trading, the reason why you don't want to set limits is because at the end of the day, channel trading ends with you getting stopped out. All right. So what I mean by that is this, and the low here is a great example, because here we've been taking out the highs over and over again. We've had deviations to the upside, but this low is a great example. So what we've been doing here, 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 and here is we've been longing the low of the range with our stop loss here every single time. So our trades have looked, you know, basically like this. Had one here, we've had one here, and we've had one here, right? Now, at some point, and let's just say that this is how that breakdown works, right? If you're shorting the top of the range, you know, and so like your positioning here at the top of the range has been, I'm just gonna do one here. Let's say you took this one. You have your stop loss above here. You're targeting the bottom of the range. So at some point, one of two things is going to happen. Either A, price is going to come down here and you long it again. You do this exact same long that we've been doing this whole time, but instead this time it goes like this and stops you out and continues to fall, right? Like this. So this is going to happen, right? And if this doesn't happen, on your short, let's say price comes up like this and you enter a short again here, and instead price goes like this and you get stopped out. A range doesn't last forever. Eventually price breaks out of the range, right? It ends with you getting stopped out. So what you want to do is to wait for price. What you do is you know, if you have TradingView, which I would hope that you do, you would right click here and you would add your alert. You would set your alert to where it is, and you would wait for price to visit this area. Once price visits this area, you watch, you see what kind of a reaction it has, you enter your trade, you put your stop loss in, and then you go ahead and trade it down, right? Now, if you're coming here to, you know, let's say long towards the bottom here, and this alert goes off that you have set here, the alert goes off and you look at the chart and you're like, okay, cool, well, I'm going to, you know, look at the trade here, and you see prices just falling and falling and falling and falling and falling, and it goes, you know, below where you would have taken your stop loss. Well, great. You just saved yourself the headache of, you know, having to enter in a position that you would have gotten stopped out on, right? So because you're expecting a breakout at some point, you're not going to set limit orders on a trade that you know could break out and stop you out immediately, right? Eventually, price is going to break to the upside or to the downside. And one, either your long or short trade is going to get stopped out. Now, if you traded the range right, what you did was you kept open 25% of your long. So here you took profit here and you took profit here. Well, guess what? You're still in 25% of that long. You shorted here, you took 50% profit here, you're still in you're still holding 50% for down here. So let's say price goes like this. Goes up here, right? Stops out your short. You had 50% open still on here. That got stopped out, but guess what? You have 25% open here still. That then gets to run up to higher prices. See how that works? It's a form of hedging that you can do with channel trading essentially, right? I'm going to go over a couple other examples, but ultimately I just wanted to. I know that we've been trading a lot of channels lately, and I've seen that a lot of people have been, there have been a handful of people that have been using limit orders on channel trading, and it's just not something that you want to do, right? You want to watch to see what price is going to do. You know, you're not supposed to try to enter up here. You're supposed to enter after it's been rejected here, right? You're not supposed to enter up here. You're supposed to enter after it's been rejected. Not necessarily here, but when it's been rejected. And we can look at a lower time frame, right? To maybe dial in. But those are the kind of things that you would look for, right? And channel trading isn't meant to be complicated. It's supposed to be pretty, mind numbing. And it can get a little bit more difficult as we have sort of these deviations to the upside that make it more difficult to place some degree of a stop loss. But then, that's where risk management comes into play. And we're going to talk a little bit more about that, in part 2 of this little risk management bit here. Okay. So we'll leave it at that for risk, or for channel trading. I want to go over, I'm trying to think of how I want to do this. I could show you guys some examples here on the chart, or I could trying to decide if I want to show you old images or if I want to draw this out for you guys. Here's another channel that was really awesome to trade actually. I'm gonna just, since we're talking about channels, I just want to, we'll go back to it because it was so great. I like vividly remember trading this channel. So here was another great channel to trade that, again, had an eventual breakdown, right? I actually had it set up here is how I was trading it, oddly enough. I had the channel set like this, and a lot of people might have done it differently, but this is how I traded it. Where I longed here, took profit at the midline, longed here, took profit at the line, long, profit at the midline, long, nope, profit at the midline, profit at the top, shorted here, profit at the midline, no short, profit here, ran. Right, that was awesome. And when you do this too, like, what's a good spot for your stop loss on these? Like you could trade, your stop loss here. For the top of the channel, obviously your stop loss would be, here. You basically use the high of the range and the low of the range as your stop loss, right? So this was another really great and easy example of channel trading. I can't emphasize, enough of how easy it is to do some channel trading. Yeah, I'm trying to decide here how I want to do this. Why don't we go ahead and, so this is my new site that I've been working on for a while. I have not released this yet. But one part of what I have on here is I'm keeping what I'm calling a memoir, right? And it just basically goes over a lot of my previous trades. So it's kind of like a trading journal, right? So I'm going to use this to show you guys like some trades that I've done that have worked well for me, why I took them. So we're going to look at, entries and stop losses. And this is all based on market order trading. I'm not setting limits on these. And by not setting limits, I'm reducing my risk to loss, in my opinion. So here, this one was very, very recent. This was January 4th or 24th. This was an FTM trade. We had this. I remember I woke up one morning and I posted this in the Discord, and I posted it while price is right here in this green circle. So here we have a wedge, right? And when price broke up here and had this deviation, oftentimes, and I'll show you an example of this, if price closes above the wedge here, you do not want to short it. That is not what you want to do. You do not want to short this. The only time that you did want to short this is when it gained acceptance back into the wedge. Okay? So when it broke up above, no. When it broke back inside and had a closure, so this is a 30-minute time frame. When we got this closure here inside the wedge, great. You can then open up a short here with your stop loss above this high, targeting the bottom of the wedge here with take profits in between. That is a trade setup. Okay, randomly entering here just because it's the top of a trend line, especially after it's broken out, is not good. And I'll show you an example as to why, because sometimes these rising wedges can then break to the upside. So here's, actually, I didn't even enter there. I'll show you when I entered. What I did, I entered in here, because if I drew a Fibonacci from here to here, this is the 382. So the 382 is holding. So I had multiple sources of confluence. I had a rising wedge, which is a bearish pattern, right? I had a deviation from the top of the wedge where it broke back down, right? And then I had a small bear flag forming on a 30-minute time frame. So for me, okay, great, this is easy. I'm going to enter here, and I'm going to have my stop loss above here, above the top of the trend line. And how else does that work? If I draw Fibonacci from here to here, if your 382 is here, well, your 618 is somewhere around here. So basically, I had my stop loss above the 618. I was entering here, and I was targeting, the bottom of the wedge. I had my take profits where? At the 0.5 fib, at the 618, and then at the 886 or the 786, whichever you prefer. So what ended up happening here, and I don't have it on this chart, but I managed to take profit here, here, and down here. I had a little bit running left, but when we saw the strength and coming back up, I had my stop loss at break even, so I didn't lose anything on that. Right? So what didn't we do? We didn't knife catch. We didn't try to say, "Oh yeah, we're going to catch this up here like it looks like it could fall." No, we were patient. We waited for the closure inside. We waited for price to give us an area, to give us a level to put our stop loss. Because if you keep shorting as price pumps, you're not given an area to put your stop loss. By then, you're already underwater. So we'll move on to let's see if we got some more examples here. This is kind of an interesting example. I don't necessarily want to use this, but I will talk about it a little bit. So when price comes down here, people oftentimes they'll look to long. A lot of people probably longed here. Right? But then guess what happened? Price came up and they got stopped out. And then it continued to fall, right? So a lot of people, what they would try to do is they would try, oh, I'm going to long here, there's a big wick. Okay, I'm going to long here, there's a big wick. I'm going to long here. Well, this isn't a trade setup. This is, you're gambling. That's all that is gambling. So here's what I like to do. Whenever I'm looking for a low to be put in, so if price is falling, what I'll do is I'll wait for price to bottom out. I'll look for a positive reaction. And positive reaction, this is what that looks like. Massive green candles, a lot of positive delta, high volume, right? Like look at the buying here. Look how low volume all that was in comparison to the selling going on here. Now look at this. The buying volume, flipped to be higher than the selling volume here. Okay. So we get that big pump. You know, you want to see some bullish divergences on an RSI or a MACD or whatever it might be. We get the pump up. And at this point, a lot of people would say, "Oh, I missed the bottom. Like I'm screwed. I missed it. Shoot, I'm just going to like enter before it's too late." And then they'll enter here. And then what happens? Well, now they're underwater and they're further underwater and maybe already stopped out or liquidated. So what you want to do instead, I like to use the 618 as a reference. Whenever I get a bottom in with a good pump like that, I'll draw my fib from the bottom here to the top here. I'll have my 618 and I'll watch for price to come down and hold the 618. And here we even deviated the 618 and reclaimed it. Now on that reclaim, that could have been your long right there. When price came back up, reclaimed the 618 and then had some market structure change. This is market structure change here. Now you can enter your long here at about 18,250 with your stop loss here at about 17,500, right? And then using technical analysis, you can find some targets on, you know, prices that you want to target for a move up. By the way, this is the 17.5K low that we put in June. Okay, this is that low zoomed in. I took some time to analyze that low, you know, to see how to basically use it as a learning example, right? So here we are looking at that now. Moving forward, I don't like this one as an example. Don't want to use this one. Okay, here's another example of the 618. So people oftentimes what they would do, they see this massive move down and here in the Discord they'll be yelling, "Oh, is it time to long? Should we be longing? Should we be longing here? It's time to long now." You know, and maybe they'll try to knife catch somewhere in here. Okay, and yeah, they get the move up, they get the move up, they get the move up, but they're not taking profit. Okay, maybe they're expecting higher, and I don't blame them. You would think that price would go higher after a dump like that. But then what happens? Price comes down, it takes out the early longers here. So they got liquidated or stopped out. And then has a massive push up. See this? 1, 2, 3 massive 15-minute candles. I don't have the volume here, but I recall this. It was high volume, a lot of positive delta. You know, this was a really big push up. And so again, what would happen? Here at the top, people would say, "Oh my God, I missed the pump. I got to enter, you know, oh shit, like we're going to be too late. I have to enter here." Instead of just being patient, draw your fib from here to here. You have your 618. Price comes down, it bounces, and it holds again. Flip bias on strong push and back test to the 618 instead of waiting for lower. Enter here. Right at the 618, you can enter here with your stop loss here. See, you waited. Price gave you an entry and a place to put your stop loss. This is all market order. I didn't do a limit order. I wasn't, you know, I didn't have a limit order assuming that this would be the exact bottom. Maybe people had the limits order here, or maybe they even had them down here and they never got entered. But by having a zone that I'm interested in longing and waiting to watch price react, whenever you see price start popping off the bottom, I promise you it's going to come back and back test at the 618 at least 80% of the time. Okay? So whenever you see this and you're thinking, "Oh shit, I missed it. Like I missed the long opportunity," just be patient and wait and watch it come back and test the 618. Now let's look at how much time this is. So this is about 8 in the morning here, and this is about 7 o'clock at night. So you had 12 out. Look at this, 12 hours. The price consolidated here and gave you an entry point for a pump that went from, you know, 16,150 all the way up to, you know, 17,150 in 24 hours. Right? You waited for a setup. You didn't just jump into a trade. Okay. Let's look at another one here. So I remember this one. I wonder if I have another picture of this, but I can tell you how it played out. This is Litecoin, and this is also pretty recent. December 9th, price fell down to, where did it fall down? It fell to about, it fell down to the 618 actually. It did, I'm pretty sure it came down here if I'm remembering this correctly, right? Because this was the bottom that we just pumped up to 90 from. So again, you know, here we have a rising wedge. We had a lot of bearish divergences on the RSI. We're also at the top of a trading channel, right? You can see this massive channel that I have here. So I have the confluence of bearish divergence, I have a rising wedge, and I have the top of a channel. So you have two entry options here. You have your aggressive entry, which is here. Okay. So you would enter based on this rejection, this move down, you would enter in here off the top of the trend line with your stop loss above and trade it down. Your conservative entry would have been in here. So when price came down, lost the wedge, and then reclaimed it and lost it again, that's your entry. And I recall this vividly, that price then essentially, you know, fell straight through. And what did we have? We had our take profit at the 0.5, which was also the midline, so that worked out well, and then the 618, right? And you can use market structure to mark out some other take profits too. So the 382 was here along with this low. So you could say I'm going to take profit here, here, and here. Piece of cake, right? Price gave you a place for your stop loss. You waited. You didn't try to knife catch every single time. Let's see. This one's pretty messy. We don't need to look at that one. Okay, so so far we've talked about like channel trading, and we've talked about wedges. One of my favorite ones that's related to channel trading are deviations. So here we have a sideways channel, right? This sideways channel, this is on FTM. This one's pretty old. This was November 4th. I remember trading this. This was super, 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 super awesome trade. So we're in this sideways channel. We can see that the bottom is very well respected. So we were putting in a descending triangle here, and price broke straight down. Now, I didn't enter in here. Not at all. You know what's funny too is I bet you this is the 618. If I were to draw a fib from here to here, I bet you that's the 618. So price came up, rejected from the channel here, came down, back tested after it broke out of this trend line. You could do an aggressive entry on breaking out of this downwards trend line that gave us that descending triangle, right? But this is an outside thing. If we were just trading the deviation, the trade would be this. When price comes in, gains acceptance back into the channel. So after this move up, people would be saying, oh my God, I missed the move up. I should have longed down here. I should have tried to knife catch. I should have tried this. I should have tried that. I missed the whole move, right? So then they're thinking, oh God, should I enter? God, I'm going to enter here, you know, and then they enter into a long. They get stopped out because the move would have been this. You wait for price to re-enter the channel. It gains acceptance into the channel, right? This is a daily time frame. So we gain acceptance into the channel. And then we back test the bottom of the channel, hold it as support to confirm the re-acceptance into the channel, and then we get the pump. Okay? And that's why we bounced so hard off of this level, because pro traders were waiting for that back test, that confirmation. And when we got that, look at the reaction. Massive, massive pump up to the upside, right? Massive pump to the upside. So, you know, what would you have done? You would have waited for price to give you a place for your stop loss. You would have waited for a move down here. You would have entered here with your stop loss here. And you would have wrote it up. You know, you could take profit at the 382, the 0.5, which was also this daily, and the top of the trend line. That worked out perfect, right? Instead of trying to knife catch and you know, set limit orders that you don't know where it's going to hit or bounce or anything like that, right? Price could have very easily, like if you had set your limit order here at the bottom at 22.11, price could have easily just continued falling. It didn't have to hold here, but it did, right? And we waited for confirmation that it did, because you can see this wick here. This is a daily candle, so we waited for the daily candle to close above the bottom of the channel, right? We didn't try to enter when it was down here because at that point, well, price could have just kept falling. But the fact that it closed inside the channel, above the bottom of the channel, that was a signal that yes, it held. We flipped it to support. Let's enter along with a stop loss and go from there. So here's a great example of when a 618 backtest does not work. So oftentimes, again, so like I said earlier, if we go back just a little bit here, what you want to see is a bottom put in, and you want to see a great reaction. High volume, a lot of positive delta, right? Preferably off of some bullish divergence. We get this massive move to the upside. See that? 3 very strong bullish candles. And then we come back and test the 618 and then have continuation, right? Let's fast forward now and look at this example. We didn't have, powerful candles moving up to the upside, right? We just had this one wick, okay? One kind of a push up, but nothing really, we didn't have that high volume, that continuing push, right? No, we just had this wick and then price sort of slowly falling. And when we reached the 618, it held and then broke through. Okay, so this is an example of a 618 retest that you don't want to long. So the idea is that here on this bottom here, what we saw this here, that maybe people tried to long this and then got stopped out, that is this bottom here, right? That's basically what this is. Or this one here. People hit here, oh, they try to long, get stopped out, wrecked. Long here, oh, yep, waiting for the pump, and then they get wrecked here, right? That's what this is. This is not a 618 backtest that you want to long. And if you did, this would be your invalidation where it falls through, right? Where you have your stop loss and you get stopped out, right? Let's see if we have some other examples. Yeah. So this one's kind of complicated. I don't know if I want to go over this one. So I have kind of this trade setup that I like to take. It's not something that like a lot of people necessarily talk about or go over. But if you have a daily level or a weekly level or a monthly level and price just falls straight through and like doesn't have a reaction off of it. So here we had a daily level, price fell straight through, back tested it. What I said was, and I actually gave you guys this trade. What's kind of fucked up is if you did take that trade and you held that long, you caught the bottom. And I didn't hold it. I closed it. I closed it pretty soon. I think I closed it up here. So what I had said was, and I remember this as we were down here, I posted in the Discord and I said, when we get a back test, when we reclaim and back test the 618, or I'm sorry, the daily level, long it. That'll be our long trigger. Because we fell through, we came down, we had a good reaction, back tested the daily, fell. But here's the kicker, right here, and I bet you this is the 618. Right here, this was a failed breakdown. So we came down, we fell through what was supposed to be support, this daily level, fell through, back tested it, flipped it to resistance. Okay? But instead of continuing to break down, we held what I assume here is the 618 and then had continuation to the upside. See this massive pump here. Reclaim the daily that was previously resistance. This was the long entry. And I remember giving you guys this one in the Discord. And, from there, we have market structure change, right? Low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, and so on and so forth, right? So it was a great long trade. It's just a setup that I like to take. It's not something that I would expect you guys to keep in mind for yourselves if you use daily or weekly or monthly levels, but I do like to use them like that. If it's an untapped level and it falls through, I think it can provide a really great trade opportunity, typically a deviation. So here's another wedge, right? So this is a falling wedge. This is a bullish pattern. And this is an ending diagonal, not that it matters, but for Elliott wave, we have bullish divergence. So this one wasn't great. This wasn't a great wedge, and you guys know exactly how this played out. We made it to about the 0.5 and then fell down to 15K, right? Nonetheless, this was a good long. I mean, we definitely made some profits on it. I know I did. I guess I'll just stop to show you guys this one because, you know, here we have our aggressive entry because we had bullish divergence. We took out wave 3 here slightly on this low. That's what makes it an ending diagonal. And the conservative entry would have been the breakout and the back test here for then a move up, right? It gives you a place for your stop loss. We're not just trying to knife catch. We wait for certain, you know, clarifications and bottoms. That's why this is the conservative entry, because the risk here would have been lower because you have a place to put your stop loss and your entry here. I'm not going to spend too much time on this one because it's a pretty messy example of a wedge. So the 618 example doesn't just have to work for bottoms, but it can work for tops too. So we have a move up here. We don't just knife catch. We wait for price to back test the 618. It rejects. We have a place to enter here, a place for our stop loss here, and we can trade it down. And of course, this is an opposite example where you kind of have, you know, things flipping and, you know, what ended up being a range forming here. But I just wanted to stop and take time to explain that you can also have, you know, that back test of the 618 for a place to enter and for your stop loss on tops, not just bottoms. Oh, and I remember why this was such a nice example here too, is you need to take time to analyze your chart and see if your trade is playing out the way that you want it to, and you can reduce your risk accordingly. So when I saw bearish divergence here on an hourly time frame, right? So here and here, holding the 618 of this move, I closed more of my short. So that's another part of risk management, is looking at your trade and saying, is this working? Is this what I usually like to see? And that's like going back to you know, this example here. If you're like, oh, I'm gonna long the 618 like I'm lockstep, like that's what I'm gonna do here. But then, you know, you start to look at it and you're like, it doesn't really have that good bounce like you talked about. I'm not seeing that high volume here. There's not really any market structure change. This is not, I'm not going to long this, right? And that's another example here is my point, where you enter the short here with your stop loss here and you get here and you're saying, oh, there's bullish divergence. It's holding the 618 on this move here. I'm going to close more of my short instead of waiting for my next take profit here at the 382. Right? So that's another part of risk management, is not just, don't just take your trade and hope. Take your trade and look at the chart without your bias and ask yourself, what is the chart telling me? Is the chart telling me that my trading plan is going to work, or is it telling me that my trading plan is not going as planned, right? This was another great rising wedge, right? So we had some bearish divergences here. We were near the apex of the wedge here. So you could have had your aggressive entry here. Your aggressive entry here, you know, where basically you just shorted based on the bearish divergence, the multiple bearish divergences, right? We're near the apex of the wedge, which means that there's going to be a breakout soon. So that's the problem with shorting this one here, is that we're not near the apex, right? You know, if you block out everything from here on, like you can't see this, you know, you would say we've had, you know, one, two, this is not really the time to short for the wedge, right? Could you short this and trade it to the bottom of the wedge? Sure, why not? But shorting here was the actual move that you would be looking for. When it comes to these wedges, you really want price action to fill up the wedge. So because we're near the apex, we have multiple bearish divergences, right? This would have been our aggressive entry. Somewhere in here with your stop loss above the high or above the top of the trend line. Then getting this move down, you could have entered multiple times in here, I think. Like even on this move here, that massive rejection, but especially when we got that daily close below, you know, the range here at the apex with everything playing out the way that it is, you could have had a conservative entry here. And this is a daily time frame. I'm sure if we would have went down to like a 4-hour or even a 1-hour time frame, there would have been other, you know, confluences and things that you could have looked at and have seen and said, yep, this is a good time to enter. Like on a 1-hour or 4-hour time frame, I'm sure here on this daily, we got the move down and back tested the wedge before then getting the daily close below the bottom of the wedge. So that could have been your entry, and then boom, you have your take profit at the 382, the 0.5, the 618, the 786, and the 886, right? Or however you want to set them up. And they all would have hit, you know, within about a 2 weeks time, 2.5 weeks time. Yeah, and here too, this is something else I want to point out. We had multiple attempts at highs here. So here was an attempt at the high, failed. Attempt at the high, broke through, but the candle closed red. Attempt at the high, and the candle closed lower on a daily time frame. This is not bullish. This would have been a great time to short. You see that kind of a weakness off of bearish divergence coming to the apex of a rising wedge. That is a great opportunity to short. So again, having situational awareness, just seeing the chart and knowing like what's the chart trying to tell me here, right? What's the chart saying? See if we have any other examples. This is a pretty messy wedge. It's a complicated wedge. I don't think we need to get into that today. The point that I'm trying to get across today with when it comes to risk management. Today I'm talking to you guys about entries, stop losses, and take profits. My goal to get across to you today is that for you to get a good entry, you have plenty of time. You have plenty of time. Plenty of time. You do not have to knife catch. You're not going to miss a trade. If you're at work or you're at the gym and you get an alert on your phone that says, "Oh, price reached the target that you've been looking for where you want to enter a trade." You don't have to stress out, stare at your phone looking at the 1-minute chart, you know, to quick enter a trade. No. Because it takes hours for a good entry to form, right? So, let's look at this example here. This we have a sideways channel here, and we have a breakout, and here I considered this a deviation. Why was that? Let's see, wave 4 of an impulse wave did not overlap wave 1, so would this have been 1, 2, 3, 4, 5? No. Back test the OB, which was the gray. Okay, so we had multiple reasons that we could have taken an aggressive entry here. Stop loss below the wave 1 high. So there's a rule that wave 1 can't overlap with wave 4 retracement. So as wave 4 retraces, it should not cross over the high of wave 1. So because this is the wave 1 high here, you can see it actually missed it by like dollars, probably like $50, okay? So when price came down here, that gave us a really easy entry where I could enter here knowing that this was a back test of the order block with my stop loss literally just right below. I mean, I could, you know, that's a super low risk trade based on that analysis, assuming that this is a deviation. Otherwise, your conservative entry would have been on the reclaim. We get a 4-hour close above here, and I assume if we went down to like a 30-minute or a 1-hour time frame, we could more clearly see the back test of the range. But we would then look here and see, yep, we back tested the top of the channel. We can get our conservative entry here, and then we can target, you know, the 618, the 786, and the 1-to-1 extension based on an Elliott wave. So we see instead of just like setting limits or just randomly longing, there's a setup, there's a method here, right? There's confluence to say this is a good trade with a good risk reward ratio. and that, you know what, that is it that we have on here. So this is, again, this is my new website under Memoir. I'm going to be adding a lot of these that you guys can, you know, go on and review and kind of look at some of my older trades that I've taken. And oftentimes I'll have, you know, some wording on here to kind of talk about why I took that trade or why I didn't, or, you know, so on and so forth. So I will be launching this soon. It is not out yet, so stay tuned for that in the near future here. Does anybody have any questions on some of that stuff that we talked about? You know, there are all kinds of examples that we can give, but, you know, today what I wanted to talk to you about, ultimately, not to sound like a broken record here, but I just want you guys to understand that, you know, look ahead. Okay, look ahead at price action. So let's go down to a 1 hour time frame and I'll show you exactly what I mean. We're going to do a replay to here. So this is price action that we have here, right? We have this massive pump up. There was a lot of money that poured into this. A lot of money. Yeah, if you guys have questions, feel free to ask. I'm going to continue to go over things, and I'll keep an eye on questions that you have come up, and I'll go over them for you, okay? And this is the point I want to get across. We're going to think ahead, okay? We're going to think ahead here and plan for a trade, okay? So when I see this here, we have this move up to here. We have this move back up to that same zone and a pretty big rejection. And then we found support here, and we know that there's a lot of money in here. These people are going to support, they're going to protect their position. So I would say to myself, I bet we're going to form a channel here. And you know, this is based off of a very large move up, right? So what happens when you have a big move up? Time and time again, you get a move up, sideways, move up, sideways, move up, sideways, move up. Why not sideways again? So I'm forward thinking here. I'm forward thinking. And I'm saying to myself, I think that this is a channel. So when price gets to the bottom of the channel, I'm going to long, take profit at the midline and at the top of the range. Okay? So I'm thinking ahead here. Now let's hit play and just watch how this kind of plays out here. Okay? All right. So far, I like what I'm seeing. The mid-range is respected very well, and that's a sign of a good channel, right? The midline is well respected. Okay, boom. There it is. All right. So I would have entered here. It broke down through the channel, and I'm thinking, oh, okay, we broke down, but guess what we did? We had a swing failure of this low here. All right, so I could have done a swing failure pattern. Or I wait, we get the closure back inside, we back test it, I long here based on this channel. Okay? And then we hit play and we continue. Right? I'm forward thinking. I mean, think about this, guys. People don't know that this is a channel yet. People aren't thinking this is a channel, right? But I am. I'm thinking to myself, this is a channel. We're going to come back up here. People are thinking, oh, now we're going to break down. Or, okay, this was the back test. Now we're going to continue up. That's what people are thinking, right? They're thinking we're going to go higher or we're going to go lower. They're not thinking we're going to go sideways for a week. All right? Boom. My first take profit hit. Take profit 1. All right, back to the bottom, long again. Take profit, hit again. Right? And at this point, people are thinking, okay, we're going to go for the high. We're going to go for the high again, right? No position, no position. All right, here we go again. Another long, right? Back test, reclaim the channel, long. All right, cool. So I just compounded back onto the long I already had opened up here, right? And I have my stop loss presumably underneath this low. Okay, take profit, take profit. People think we're going to break out, break out. I think, oh, we just closed back inside the channel. Short, take profit one, hit. And you guys get the idea. I mean, you know how this channel played out. We stuck in this channel for almost 2 weeks now, right? You get the idea. And it all started right here because I was forward thinking. I was able to get these setups and these trades and know where to put my stop loss, okay? And what I'm saying is that think ahead on your trades. Look and ask yourself, are we forming a wedge here? What's the formation? Like, what's happening here? Like, you know, is this I not that this is a good wedge or whatever, but you can say, you know, is this a you know, we have a wedge forming here. Okay? Yep. So we got a wedge. Like, you're forward thinking, you're looking at it, you know, from here. You're already looking at a wedge. You're thinking to yourself, I think we're going to be forming a wedge here, and it continues and continues and continues. And then you look for, you know, the bearish divergence, right? Here it is, bearish divergences, right? And then you look to enter and you have a place for your stop loss and all that stuff and whatever, right? You're forward thinking and you're not setting limits. You're coming up with a plan here on Monday and you're taking the trade on Wednesday. Right? You came up with the plan here and you said if this wedge forms here, when we get some bearish divergences, I'm going to take the trade. I'm going to have my take profit set at the, let's see here, the 0.5 and the 618. The 0.5 and the 618, boom, boom, both profits hit. Maybe you also had it set at the 886. Boom, the 886 is hit. Great, you got all three of your take profits. And then you see this massive reaction and you see the 618 holding for 2 times here and you say, great, well, I'm going to long here with my stop loss here. And boom, market structure change. Okay, great. And then you trade it back up to new highs. Look at that. Right? You're forward thinking. When you see this here and you're thinking, oh, I'm still in part of my short, I'm going to hold it because I think we're going to dump more. When you see price bounce like this and hold the 618, are you still thinking price is going to dump more? No, you say, all right, I'm going to close my short here. Time to long, right? You're forward thinking. You're looking for entries. You're not just saying, you know, price pumps up like, oh, time to short, or like, oh, price dumps, it's time to long. No, you have a setup. You have a reaction, right, that you look for. So we do have some questions. Let's see here. How to determine the time frame to confirm the TA? This is a really, really good question. This is a really, 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 really good question. That I've asked myself quite a bit. Let's see if we can get that back. No, we cannot. I'll redraw it. This is a really good question. So if I just go like this, we're gonna redraw this channel. Okay. So I think we're gonna put it a little bit lower. There we go. So I have the perfect example because I recently traded it and I lost money on it, so I'm not going to forget it. So we have this channel. Now what's interesting about this channel is depending on the time frame, right? If we go to a 30-minute, we can see that price is closed below the channel here, here, and here. So all in here, price is closed below the channel on a 30-minute time frame. So if we're thinking to ourselves, oh, price closed below the channel on a 30-minute time frame, it's time to short, right? Well, then you would have got stopped out and watched price go to the top of the channel again. Or here, price on a 30-minute time frame, it closed above the top of the channel. okay, it's time to long, or like, oh, here's the back test, let's long it, and then it continues down and continues to trade the channel. Same thing here, multiple 30-minute time frame closes here, right? And you're thinking to yourself, oh shit, then this is definitely, like, this is the breakout, we're gonna long some kind of a back test or something, right? So here's what's interesting about that. Let's go to an hourly time frame. Okay, we still have these closures below here, still have the closure above, still have closures above. Let's go to a 4-hour. Oh, interesting. Okay, when we go to a 4-hour time frame, what happened now? We did not close a 4-hour below here. We did not close 4 hours below here. On a 4-hour time frame, the bottom of this range is holding every single time. Every single time. Even here, right? The 4-hour held. Here the 4-hour held, and here the 4-hour held. Now here is where we actually had a true deviation. Here's where we had a true deviation, where a 4-hour closed above, but then it closed back inside, right? We had a massive rejection in it, and when it came time for it to back test to give us a potential long, it didn't hold, right? Let's go to a daily time frame. And again, on a daily time frame, you can see that price has not closed outside of this channel with the exception of this day here. So this was a true deviation, right? That was a deviation. Let's go to a 2-day. On a 2-day time frame, price has not closed outside of this channel. Okay? So the point I'm trying to show you here is that on a 30-minute time frame, an hour time frame, price is closed outside of this channel many times. Okay? On a 4-hour time frame, price is only, so we'll go back. On a 30-minute time frame, price is closed multiple times. Hour time frame, multiple closures below or above the trend line. 4-hour time frame, only one time has that happened. Only one time, and that's here. This is a true deviation. Other than that, prices stayed, closing the 4-hour in here. So what you can assume, right, what this allows you to assume is that if you wick down here and you long, you would say, well, if price closes the 4-hour back inside, then my long is fine. You long here. If the price closes back inside on a 4-hour time frame, then my long is fine. Same thing here. If you shorted the top here and you said, well, as long as the 4-hour closes inside, then my short is fine. Right? And it did by a significant amount, right? So that's how you can use time frames to tell you if a trade is good or right or not. Especially on a daily, right? So when I saw this daily break up to the upside, I was thinking, oh damn, like, maybe this is a breakout. Okay, until the second day here that we got the closure back inside, right? So to answer your question, the question being how to determine the time frame to confirm the technical analysis. The higher the time frame, the more important the closure is. Okay, so 30-minute, a 1 hour is more important. A 4 hour is more important than a 1 hour. A daily is more important than a 4 hour. A weekly is more important than a daily. A monthly is more important than a weekly, and a yearly is more important than a monthly. Right? The higher the time frame the closure is, the more significant that level is. Okay? Now, determining it for specific trades, I've already went over that, right? You do not want to use, so this is a great example. I shorted in here. I shorted this because we had here, we broke down, right? And we back tested here, and I shorted the back test. And then I went to sleep. And I woke up and I saw that price deviated back inside. It bounced here, revisited my entry, bounced here, and it went lower. And I was thinking, oh, yeah, this is a pretty bad bounce here. We're probably just going to drop through, right? Well, then we reclaimed it again and then had a massive pump that I got stopped out on. Now, what could I have done instead to confirm a deviation? well, I could have changed my time frame. And I remember saying this after I shorted here. I went to a 4-hour time frame, and I remember posting in the Discord. I remember exactly saying this. I said, "Oh man, my short is not looking good because the 4-hour held the bottom of the channel." Right? In fact, it held at each and every one of these 4 hours before then getting that massive pump. So it's important to use, those different time frames to confirm different things, and it's all based on where we are. We can see that the 4 hours is very well respected in here. It's the lowest time frame that I have that is very well respected, where we have not had a closure outside of it with the exception of this deviation. Right? So if we got a 4-hour closure below the trend line here, or below the channel, chances are it's going to continue to the downside. Say there's a good chance of that, right? Otherwise, we would just have another massive deviation. Okay. Now, on the other hand, if price comes down and it wicks like this and then closes back up here after taking out this low, well, that's a swing failure pattern. We're continuing to hold the range. It's more likely that we'll continue to trade the range or maybe even break up to the outside. Okay. Let's look at some other questions. Can you show how to have that background color on TradingView? I'm not going to get too much into that, Luca, but I encourage you to, if you go to my tutorials, trading tutorials playlist, I have a TradingView cosmetics video. It's very short, and I review how to change everything that you want on TradingView. Okay. What I'll say very briefly is that if you right click on the background and you go to settings, you can change your background here to solid, and you can change the color. You can go to a different, you can change the color of the grid lines and et cetera, et cetera. You just simply do that by right clicking here, going to settings, going to appearance, and then you can change whatever it is that you want. If you want more details on all of that, like I said, check out my TradingView cosmetics in my tutorials playlist. How do you decide where you draw your fibs? Swing low to swing high or high to low. Henry's correct. You do draw them from your swing high to swing low. One other thing I want to add, and this is just my personal preference. I know some people disagree with this, but typically speaking, when you're drawing your fibs, you want to draw it from left to right. So he's right in saying that you would draw from a swing low to a swing high. So for example, like swing low to a swing high. That's correct, but you wouldn't want to draw it like this. You would want to draw it from left to right, right? Or if you're going to draw from a swing high to a swing low, you're still going to draw from left to right. Okay. How to play it for the take profits and stop. So how to use fib. Yeah, I would say Henry's correct on that. Last question, what time frame are you thinking for the MLOC website? Yeah, I would say by the end of the month. It could come sooner, but I would say by the end of the month. There's a lot of pretty cool stuff in here, so it's ultimately it's a one-stop shop for everything that's memory lock. I'm gonna have an Instagram that's all news, so any current news going on, it'll all be posted there. My Twitter, you guys know, I post charts and trading updates and stuff there, and then my YouTube, of course, you guys know all about that. I'm gonna have all my market updates posted here, all of my live streams posted in here. The key will be my source for future trading tutorials that I'll have coming out. The beginner indicators, patterns, Fibonacci. This will all take quite some time for me to divvy out. We're not quite, we're not quite there yet. I recently became an official Bybit partner. So, we'll also have a place where you guys can come in and, access that link to get some more rewards than you otherwise would by signing up with Bybit and depositing. And then here, have a spot for Crypto Dreams as well. Um, and that's about it. And also a place for mentorships. I'm not sure that I'm going to be opening up any mentorships at this time right now, but we are going to have some kind of an application where people can go and fill them out if they are interested in. And then, of course, the memoir, which we talked about in length today, which to me, this is one of the coolest and most important parts of the website, outside of, going into the market updates and the live streams, right? So, yeah, we'll call it there. Thank you, Henry, for the kind words. I really appreciate it. I will keep you guys up to date on the website and all those things when the time comes to release it. Otherwise, I'm really happy that we got some time to go over this. I know it was a pretty long lesson, but if you do take the time, it will be uploaded. So take the time to watch it, to rewatch it. Whenever you're unsure as to where you want to enter, stop loss, anything like that. The whole point, in summary, trades aren't taken in seconds. Okay, there's hours, always hours to enter a trade. Wait for price to give you a place to put your stop loss. Don't knife catch. Okay? And then always have your take profit set and have situational awareness for your trade. Ask yourself, I've taken a rising wedge trade, 100 times. Look at that rising wedge trade and say, does this one look like it's going to play out like how I would expect it to? Have situational awareness. Look for confirmations, things like that. Last thing I'll say is on Friday, I am going to do like a part 2 to this risk management thing. That part 2 is going to be, so there's a lot of math that goes into risk management that no one actually wants to do. And I'll give you just a little, like kind of like a little teaser as to like what we'll talk about. But trading is all based on percentages. So oftentimes people, when they take a trade, they'll be like, I'm gonna long here, and I want to make $500 on this trade, or like they'll get up to here and it'll be like 150, and they're like, like I think we can get more, like I think it'll go higher, and then here they're like up $300, and they're like, shit, like what if it keeps pumping? What if it keeps pumping? I could get $500 or something or more, and then it drops down, and how it is with channel trading. Well, then it comes back and revisits their entry, and they're upset. They're like, oh shit, I could have had all that money and now I don't. Like, and that's why, right, you'd have your take profits and all of that stuff set, preset and whatever. But the point is it's not based on dollars. Okay, it's based on percentages. So like, if you have a you know uh let's say you have a $10,000 portfolio where you're only ever gonna wanna risk 2% on that trade. So, like, just as a very brief example, and then we'll cut it off here. But if we're gonna be taking our long, just like we've been talking about, where we put our stop loss below the low of the range, which is here, and we're going to trade it back up to the top of the range, right? Typically you want your risk reward ratio to be 3 or more. So this is good. And this stop loss, the point is that this stop loss, if price were to come down here and stop you out, you only lose $200 or 2% of your $10,000 portfolio, right? Now, and here's the thing, that 2% is different for everybody, right? If you have a $100,000 portfolio, that 2% is $2,000. So here it falls through and you lose that. Well, you just lost $2,000, but you know, you the difference is that 2 grand for someone who has a $10,000 portfolio is 20% of your whole portfolio. You never want to risk. I typically only risk 1 to 5% of my total portfolio, and I rarely go over 2%. So that way, right? What happens then is if I lose, you know, one trade here, okay, I lost $200. Well, now 2% isn't $200 anymore. Now it's like 194. So on this next one, if I get stopped out, I lost 194. Well, on the next one, 2% isn't 194 anymore. Now it's, 188, right? So that 2% amount changes, and that's what people don't trade based off of percentages. They trade off of dollar amounts. They'll say, I'm only ever going to risk $100 every single time. Okay, you keep risking $100, and, let's say, that $100 was 1% of your portfolio at 10,000. Well, now it's, at $1,000, now that 100 is 10% of your portfolio, right? It's just really important to trade based off of, percentages, not based off of dollar amounts. And that's kind of what we're going to talk about, just to give you guys kind of an idea. I'm actually going to release a trading tool for you guys that it'll do all the calculations for you. I'll work on it this week. It's something that I've been meaning to do, but I'll try to get it all done. And basically, it'll do all of your calculations that you'll need, so you won't have to do it yourself, right? So, all right, cool. We'll cut it off there, but yeah. So that's exactly what we'll talk about. The question is how to allocate money for trading. Let's say the spot portfolio is 30K. How much should I allocate for trading futures? What is usually recommended? And that's kind of the stuff that we'll talk about. But if your total portfolio is 30K, depending on what you want to do, if you're new to futures trading, you're not going to want to risk a lot. You're going to want to practice. So, why not take $1,000, put it into the trading portfolio so you can trade with it and only risk 2% of your total portfolio per trade, right? Or if you want to do $10,000, again, you're only risking 2% per trade, right? And that 2% figure changes based on the amount, based on how your portfolio changes. So we'll talk more about that. I mean, I think the specific question that you're asking is more sort of up to you or personal preference. But we're going to talk about after the fact. So after you've allocated money into your derivatives account to trade futures, how much should you be risking per trade? That's what we're going to be talking about. And there's actually mathematical equations that can spit out those numbers for you exactly of what you're going to want to do. So we'll close it out there. Yeah, it's always 2%. So you never want to trade, 1 to 5% of your total account is what you want to risk per trade. So we'll talk more about that on Friday. I don't want to get into too many details with it now, but thank you guys for joining me today. Maybe we'll look to do more live streams like this in the future. This seems like something that everybody really liked or did enjoy. So thank you guys again for joining me. I'll be in the Discord today. I'm going to leave my house, go run some errands. I'm going to do my best to make it back by the FOMC meeting, and we'll do a watch party where we can all hang out and watch it and see how crazy Bitcoin gets in reaction to whatever the Fed decides to do today. So enjoy the rest of your day, guys, and I will see you in the Discord.